Guaranteed 10% returns per day. No risk. Your money working for you while you sleep. If you've ever scrolled social media, joined an investment group, or received a private message promising effortless profit, you've heard a version of this sentence. Maybe it mentioned crypto, maybe real estate, maybe an exclusive private fund, different assets. Shame. Promise. What most people don't realize is that this sentence isn't modern at all. It's over a century old. This exact idea is the foundation of the most influential financial scam ever created, a scam so effective that it didn't just steal money. It gave its name to an entire category of fraud. This is the story of Charles Ponzi. But more importantly, it's the story of why his scheme still works today. Charles Ponzi didn't begin as a criminal mastermind. He began as a man chasing legitimacy. An Italian immigrant who arrived in North America, convinced that success was just one clever idea away. But reality didn't cooperate. Every legitimate business he tried failed. He struggled constantly with debt, instability, and disappointment. At times, he crossed legal lines and paid the price with prison sentences. Yet prison didn't break him, it sharpened him. Ponzi learned something essential. Systems matter less than perception. If people believe an opportunity is rare, smart, and already working for others, logic becomes secondary. His famous idea revolved around international reply coupons, a dull, bureaucratic postal instrument that almost no one understood. Ponzi claimed there was an arbitrage loophole: buy these coupons cheaply overseas, redeem them at a higher value in the United States, pocket the difference. The explanation was complicated. That was intentional. Complexity signaled intelligence. Confusion discouraged questions. But here is the critical truth. The business was impossible. The math didn't add up. There weren't remotely enough coupons in circulation to support the volume Ponzi claimed to trade. The infrastructure didn't exist. The margins were fantasy. Yet none of that mattered, because Ponzi wasn't selling coupons. He was selling certainty. He promised investors returns of up to 50% in 45 days, guaranteed. No risk, no volatility. At a time when banks offered slow, conservative interest, that promise spread rapidly. And this is where the scheme crossed from clever lie into self-sustaining machine. Ponzi paid early investors exactly on time, not with profit, but with money from new investors. This single mechanism is what defines a Ponzi scheme. There is no real source of returns. Payments are fueled entirely by constant inflows of fresh capital. As long as confidence remains high and growth continues, the illusion survives. And the illusion was powerful. People trusted results more than explanations. Checks cleared, cash appeared. Friends told friends. Families invested together. Entire communities followed the trail of visible success. Trust became viral. Newspapers praised Ponzi as a financial prodigy. His public image exploded. Expensive suits, luxury cars, extravagant homes, all reinforcing the narrative that he had cracked the system. But beneath the surface, the structure was decaying. A Ponzi scheme isn't just dishonest. It's fragile. It requires exponential growth to survive. Every payout increases pressure. Every new promise narrows the margin for error. The operator becomes trapped by their own success. Ponzi wasn't managing an investment business anymore. He was managing timing. Eventually, scrutiny arrived. Journalists questioned the logistics. Economists examined the numbers. Regulators began demanding documentation. As doubt spread, the behavior of investors changed. Withdrawals accelerated. New investments slowed, and the mathematical reality asserted itself. When the scheme collapsed, the damage was catastrophic. Millions of dollars vanished. Thousands of families lost savings meant for homes, education, and retirement. The trust that held communities together fractured overnight. Charles Ponzi was arrested, convicted, deported, and ultimately died poor and forgotten. But his idea never died. Instead, it evolved. Because what Ponzi truly discovered wasn't a loophole in postal systems. It was a loophole in human psychology. Every modern Ponzi scheme follows his blueprint. Replace coupons with real estate deals. Replace real estate with hedge funds. Replace hedge funds with crypto staking platforms, yield farming protocols, or AI-powered trading bots. The asset changes. The psychology does not. Modern Ponzi schemes promise stability over realism. They emphasize community, dashboards, testimonials, and early success stories. They reward loyalty, discourage skepticism, and frame withdrawals as betrayal or most importantly, they weaponize urgency. Your early spots are limited, returns are guaranteed for now, and just like in Ponzi's time, early participants become the loudest promoters. Not because they understand the system, but because they've already been paid. That's the trap. Ponzi schemes don't survive because people are stupid. They survive because people trust patterns. When everyone around you appears to be winning, doubt feels irrational. Charles Ponzi taught the world that belief is more valuable than infrastructure. That convincing people something works can be more profitable than making it work. And that lesson still echoes through modern finance. Understanding Ponzi isn't about ancient history. It's about pattern recognition. Once you see the structure, you start seeing it everywhere. In private groups, influencer promotions, guaranteed return platforms, and too consistent to fail investments. The man is gone. The method is everywhere. If you want to understand how financial scams actually operate, not just what they promise, but why they succeed, subscribe to the channel, because the next Ponzi scheme won't call itself a Ponzi scheme, but it will begin with the same promise. Guaranteed returns. No risk.